Tesla's share price has taken a tumble once again, this time dropping 12% on the New York Stock Exchange. It's yet more bad news for Elon Musk's carmaker, which had a rough time last year. The value of the company's shares plummeted over 65% in 2022. The problem, at least in part, is that the company missed the expectations of investors. Tesla sold 1.3 million cars last year, more than ever before. But instead of 50% sales growth, sales increased by only 40% compared to the previous year. Sales still went up, but investors worry it could be the early signs of a slowdown. Meanwhile, Reuters reports that the previous boss of Tesla's Chinese operations, Tom Zhu, has been promoted to take care of the company's North American sales, plants and distribution, a move that puts him second only to Elon himself. Well, we can hear more about this from Jens Korte, who has more on this from New York. Jens, tell us more about the reaction on Wall Street to Tesla's results. It seems that they were quite disappointed.
Yeah, Daniel, clearly investors on Wall Street were not too happy, and the same is true for analysts. There were actually a couple of analysts from the big banks who either downgraded the stock or lowered the price target for that company. It's not only about deliveries at this point. I mean, as you mentioned, they are historically high, and then with the new plants in Berlin and also in Texas, deliveries could still be on a pretty good track. But another concern by now is actually profit margins. So we did hear from Tesla that in certain cases they, for example, offer some incentives so they could get less per car, and that could put profit margins under pressure, and that's what Wall Street is focused on at this point. Let me take one example from an analyst who isn't that downbeat. Goldman Sachs, for example, they did lower the price target for Tesla, but they're saying in the long term it still looks pretty good for Tesla, as they might remain being the leader when it comes to EV mobility. But clearly at this point, a lot of trouble for Tesla and not a good start into the new trading year for the company.
Yeah, it looks like plenty of problems to fix, at least on investors' opinion. Jens Korte in New York, thank you very much. Peter Fintel is Vice President of Technology at Capgemini Engineering. Thank you very much for joining us, Peter. Tesla is facing a multitude of difficulties right now. Where do you see the biggest pain points for the company?
Daniel, thank you very much for having me. Well, clearly, Tesla, a company that was always had an aura of success, had a lot of headwind in the last years, right? So first and foremost, we all saw it from the press. There was an increasing number of product recalls throughout the year. They had safety investigations from legislators, most around their automated driving / driver assistance systems. There have been a questionable progress and also safety concerns on Tesla's full self-driving vehicle software suite, right? And last but not least, to the year end, there were public concerns over Elon Musk's side activities, namely his stake in Twitter, his voicing out of questionable political opinions, and last but not least, his other obligations, yes, with the other companies. And all that overshadowed the success of Tesla in 2022 and put some scratches into the shiny metal of Tesla so far.
And its stock has slid over 60% in the past year. Could it be that Tesla was just overvalued in the first place?
Well, clearly, I think the stock market is trading expectations, yeah. And if you listen to the Tesla story, revolutionizing mobility, revolutionizing energy markets, and also potentially revolutionizing manufacturing in the future with this Optimus robot, well, there are a lot of stories that I would say justify a high valuation. But in reality, you see that the market has moved on, and Tesla acted as a catalyst in order to bring electric mobility to the masses, and a lot of competition has scaled up. And also clearly in the next years, we will see that Tesla is, at least for its vehicle, operating in a limited market. Even if we are very, very bullish, we will see the vehicle market not grow beyond 100 million vehicles per annum, right? And if Tesla would continue to grow with the current rate in 2030, they would be around 30 million vehicles per year, and that would be a market share of 30%. That's not very realistic. Yeah. So I think if we see a downscaling now of the expectations and also the effect on the stock market.
Okay, and Reuters reports that Tom Zhu has become second in command. What do we know about Zhu, just briefly if you can, and why has he been drafted in?
All right, clearly. In the past, Tesla was very keen to always foster the image of Elon Musk, the one man rules it all. But we should not forget that Tesla is now a company with a staff of around 100,000 talents. Yeah, so clearly it needs a functioning organization in order to run this company profitable and successfully. So Tom Zhu he's with Tesla since 2014, right? So he started. He was tasked as a person to build up the supercharger network in China, and very soon became general manager. And in the last year, he has been more widely known as the manager who kept the Gigafactory Shanghai open during COVID, right? He's a real and accomplished manager. And Tom Zhu, many people think, oh, is this a Chinese now running Tesla? Tom Zhu has a very international background. He's Chinese born. Okay. He holds a New Zealand passport, and he also did his MBA at the renowned Duke University in the US, right? So in his previous jobs, he worked across the globe, even in Africa. So I do think that he brings the determination and the cultural background in order to make this new task successful.
All right, that's Peter Fintel there from Capgemini. Thank you very much.
Thank you very much.